Silver is something that is needed. It's essential. It's imperative. You cannot run a society without silver. These are the words of today's guest on Gold Core TV. David Morgan joins us to discuss the miracle metal that is silver, the metal of many faces. It's something you can wear. It is, of course, money, and it is a major industrial metal. When we sat down in the Gold Core offices to come up with some examples of how silver is used in industry, the list really was endless. In short, if it has an on-off button on it, then it's got silver in it. If there's a need for a sterile environment, then silver's in it. If you want to live sustainably, then you need silver. Even your washing detergent contains silver. So yes, silver is vital to life, but it's also vital as money. For millennia, societies have used it as money. And why is that? Because it's a safe haven, an inflation hedge. In fact, silver coins are more common in history than gold coins. It's the accessible precious metal that has a use in both the good times when industry is booming and the bad times when the proverbial has hit the fan. So where are we now? And what role is there for silver? We spoke to David Morgan to find out more. David Morgan, welcome to the M3 Report.
Well, thank you, Dave.
It's great to have you on here. I want to start with a question. We have got inflation just shy of 10% in the US. We've got heightened geopolitical tension, particularly with the war on the continent of Europe. And we've still got the world fairly much awash with money. What makes silver the perfect investment in this environment?
Well, that presupposes that silver is the perfect investment, but I would say it's probably right on up there. There's a lot of reasons. I think the number one reason is particularly in commodities, not so much in equities. It's always good to buy low. And I have one of these many books back here. There's one called You Cannot Lose Trading Commodities. Now, if that isn't a title, that'll wake you up, because 99% of the people that try to trade commodities lose. So why in the heck could you even write a book like that? And the premise of the book is, if you wait and you see an opportunity to buy any commodity, be it an ag, be it a soft, be it a metal, under the cost of production, and you are patient, you can't lose. So the thesis is that whatever the commodity is, if it cannot be produced at the cost you can buy it for, eventually it's going to have to rise in price. And then he does like a scaling in, where you look at, what your bank account bankroll is, and you act accordingly. So I really thought that made a lot of sense. And it does, because he used sugar in his example in the book and a couple others. And in all cases, eventually the commodity will come up. So that's number one, is that the true cost of silver, all in sustaining cost, is pretty close to where we are right now in US terms, US dollar terms. You could argue there's a couple primary silver producers that are under the 19 and change level, but it's a cat's whisker. And with the cost of petrol and diesel going higher, I can, do the math in my head more or less on a broad base and say, look, it's going to be much higher because fuel costs are so much higher. So what they showed me is all in sustaining cost, at the end of last year, it's gone up significantly. In some cases, fuel costs account for 25% of their expendables, not their capital outlay for the plants and equipment, but what they use as a consumable, which is fuel, primarily. And of course, labor costs in some jurisdictions are going higher as well. So David's simple answer, you're buying low. What else? It's used in a war effort. It's in a continual deficit, more or less. The above ground stocks have built up over the last several years, actually. So there's more silver sitting above ground, but most of that silver that's above ground is already bought and paid for and owned once, twice, or multiple times. So there's very little what I call float that's really available to the market. The reason, we'll get into the reason why we still have the price we have. So I'd say it's buying low. And the last one is, there isn't a lot of silver left. Now, I think we've hit peak gold. I really think so. But I don't think we've hit peak silver, but we're close. And silver is something that's needed. It's essential. It's imperative. You cannot run a society without silver. You could actually run a society without gold. And so if you get in a real squeeze and had to make a decision, well, I've got X amount of, you know, funds, so much energy left to build out another mine, and you have a choice of a gold mine or a silver mine, it would become a silver mine. Because if you got to the last amount of money to produce one more mine, silver is so essential that that would take precedence over digging more money out of the ground.
Okay. Well, given all that, then why is it that we're seeing silver currently trading below $20 and most recently below 19 and close to $18 an ounce?
Well, first of all, that's in US terms only. So if you look at it in other currencies, silver's doing fairly well. But the reason is it's based on an outlier. It's based on the way the futures market works. And the way the futures markets work is how much supply and demand is there of paper contracts. And there's basically an unlimited supply of paper contracts. You could create a piece of paper that says 5,000 ounces on it indefinitely. So that's part of the answer. The other part is, well, if that's true, then why doesn't someone stand up and take delivery off the exchange and then the paper game? And the answer to that is that there's restrictions. The only one that did that in modern times was Warren Buffett. In the late 1990s, he bought 129.7 million ounces off the exchange, which was a significant amount. I forget the percentage. And after that was accomplished, and it took them a while for him to get the full bill. In other words, you got 90 million ounces, and several months later, they completed the 40 million ounces. If I said billion, I'm mistaken. It was 90 million ounces and then 40 million ounces. It took about 2 years to fulfill the order. And they changed the rule. The rule now says you can only take 3,000 contracts. So 3 times 5 is 15. So you've got 15 million ounces you can take at any one time. That's by their rules. And when you sign up for their rules, you sign up that you're going to trade a paper contract and they can settle with metal or they can settle with cash. So if someone were to come in and do a Buffett, first of all, the exchange would probably give you a phone call and dissuade you from doing it. But if they didn't do that, you just stood your ground and you'd only be able to get 50 million ounces every month. And then at some point, they might just say, here's your check, because read your contract, Dave. Mr. Dave Russell, you signed this contract. It says we can settle in cash. So the idea that you can break the COMEX is out there. And certainly I think you could get close enough for it to be a real problem. And the reason being is that even though those rules exist that I told you, if there's a big player that demands physical and they really pretty much have to deliver, and they can, of course, they'll go to the LBMA. They'll go to London first and say, hey, help us out. And all these bullion banks work together, so, name a bullion bank, talks to another bullion bank. Hey, lease us some more silver or loan it to us or swap it with us or whatever. We got to get it to Apple Computer, and we don't want to have egg on our face. So I think it will happen, but it won't happen in, the COMEX can't deliver silver. Well, they could do that tomorrow and still retain what they have in the registered and eligible categories, and just give a wave, if you catch my drift, to the market and say, hey, you guys, we're just obeying the rules you signed up for. We're settling all contracts in cash. We need silver for the war effort right now. Without silver, we won't be able to win this war. I'm making that part up, of course. We've given an extreme example, but silver is a strategic metal. It is a metal of war. And the exchange can make up any darn thing they want. We've seen that in the past. So
a metal of war. Can you explain that one to me?
Well, if you look at first of all, a lot of the batteries are used in the military use silver. They don't use lithium. Of course, they do use lithium. There's a lot, but some of the most hardcore, got to have it, got to be reliable, must need it, uses silver. The other one is what's used in like a cruise missile, is a phenomenal amount of silver purportedly. So there's a lot of stuff that is used in the military that uses silver that no one ever talks about. In fact, me being, pretty good, I don't want to pat myself on the back and break my arm, but I dig pretty deep in the silver world. And the one statistic you'll never see or never can obtain is how much silver does the military use on an annual basis. That never shows up in either study from CPM or the World Silver Survey. Handy and Hardman, if I recall correctly, used to say something briefly about it, but no one really, and you can't go, I haven't been able to, maybe someone's better than I can find it in a government document, but I doubt it. I doubt they would break that out and let you know that, they're increasing their use of silver because we're building more weapons. I don't think that would show up.
Okay, fascinating. It's not something that has been on my radar before. The idea of silver as a war metal. It's very interesting, and it also confirms how silver then also, when we have heightened geopolitical tension, how silver can act as a hedge against that, as well as a hedge against inflation. And with costs running at, I think it was 25% in terms of fuel, the production costs.
In some cases, that's right.
Yeah. Which really underpins why it's a good hedge against inflation, and particularly energy inflation.
Let me stop you there just for one more. Just to emphasize that point you just made. Mm-hmm. There's a very high correlation between oil prices and the price of metals. So you see these runaway oil prices. You usually say you see a spike in oil. You will usually see a spike in the metals as well. Not at the exact same time. There's a lag, but it takes place.
Indeed. Just to change tack for a second, the last print we've seen in inflation is 9.8. That's the official level of inflation. The unofficial is probably an awful lot higher than that. Do you see the central banks, do you see the Fed actually being able to tackle that without utterly destroying the economy?
Do not. I mean, the truth of the matter, and you don't hear it often, you'll hear it from alternative financial types such as myself, is the only way to really get inflation under control is what the Fed knows to do, and that's to raise interest rates. But the problem is you need to raise interest rates above the inflation rate. So if their official inflation rate is 9.8, that means you need at least a 10% rate on the 10-year, for example, in order to break even and not lose any money. So if you're putting your money to work on a 10-year note in the US Treasury and you're getting 10% and inflation's 10%, you just are treading water. You're not making a dime, but you are at least staying even. So to make it worthwhile, you really have to raise it above the inflation, which let's say it was at 12%. So you're making 2.2% real interest, and that would probably kill the gold market. That's what happened in 1980 with Paul Volcker. Well, now people don't really understand the history or the mechanics I just outlined. So the idea is we'll fool them. We'll tell them we're going to raise interest rates, and that's going to kill the gold market. And you see gold react to that because it's basically rhetoric. It's just hot air coming out of politicians' mouths and financial markets telling you that, interest rates are going up. It's going to kill gold. No, it won't. Gold will continue to move higher. Yes, I know we're seeing, lows in silver, and I know gold's off substantially, and that's part of the market. And if you want me to continue on why we're there?
Indeed, yes.
Yeah, please. I think the reason we're there is pretty obvious, and that is we're doing a 2008 all over again. Mm-hmm. We're going to witness, or we're on the process of seeing the next financial crisis unwind. So in 2008, you saw gold go down substantially, and silver went down even more percentage terms. But once the bottom was hit, the first thing to react was gold and silver to the upside. So silver went up over 500% from the 2008 bottom, and gold more than doubled from the 2008 bottom. So this time we're selling off as expected in a financial crisis. We just haven't named it that yet. And you're seeing gold and silver sell off, but they're selling off what? Less than everything else. You look at gold versus housing, you look at gold versus the S&P, you look at gold versus bonds, you look at gold versus anything. And in most currencies, it's up, and in the US dollar, it's flat or slightly lower, but it's a lot less low than everything else I just named. So what's it doing? It's reacting as you would expect gold to react. It's going down with the market, but it is at a much softer decline than anything else. Well, why is that? If gold should, be the counter investment to, let's say, the stock market, which it is, why would it go down? And the answer is there's so many derivatives. I think, now this is conjecture totally on my part, but if only gold investment you could make wasn't a futures or derivative or an ETF, and you had to buy physical gold, I don't think it would go down. But you don't have that market. You have all these paper derivatives. You've got futures, you've got options, you've got swaps, you've got over-the-counter derivatives, you have swaps, you have loans, you have the futures market. So there's a lot of ways to own gold that isn't really gold, but the selling pressure of those derivatives will drive the price. The whole market of gold and silver is determined on a derivative. It's not determined on the physical metal, which most people, the physical metal, you could argue, it's not totally true, but you could argue the physical metal is the real market. So when you go to your coin dealer and you're paying, $30 for silver when it's showing 18 on paper, what's the real price? Well, for the person that just paid 30, their real price is 30. Now I have to be fair, and that is that you could get it off the exchange for close to the 18 I just mentioned, but but you couldn't get it in a retail market for that price, or anything close to it.
You mentioned there that we're in a financial collapse, which is not we're not highlighting it or talking about it, or the powers that be aren't, and it feels very much like the idea of you throw a frog into boiling water and he jumps straight out, or you put him into cold water and slowly bring him to the boil and he'll stay there till his skin falls off. That kind of has a feeling. An echo of what's happening at the moment. I mean, if we were to roll back 12 months, 18 months, 2 years, and say that in 2 years' time, we would see a correction in the stock market that we have seen, we would see official inflation at nearly 10%. We'd probably be talking about a global financial collapse in stronger terms than the current narrative. Would you agree with that?
I do, and I think I want to make a clear distinction here, and this is very important for people to understand. There are two markets here that people think is the same. There's the economic reality or the economy, and then there's the financial markets. And what the financial mainstream has been able to do and fool most of the people most of the time is that the financial markets represent the economy. And it's not true. So the idea is that, well, look at the gold price, look at the stock market, look at the housing market, look at this over here, while the actual reality is the economy. It has nothing to do, well, it has slightly to do with the financial markets, but there's not much of a correlation anymore. So now we're at a point where the financial markets are just starting to show the economic reality of food shortages, supply chain breakdown, more political tension between nation states, high unemployment, strife and fear in the markets, people being depressed and not being able to find a job, or if they find one, they've got to do 2 or 3 jobs when they used to have a better paying job. So now to make up for it, they have to work twice as hard and get half as much pay. All these things that are actual reality for the economy, so you can put food on the table, drive your car, and get to work, and maybe put a roof over your head and maybe pay for some health care. When you take all that stuff into account, people are hurting globally, and it's only going to get worse. So that's the economic reality. In the meantime, if the stock market recovers, or maybe they what's called pivot and the Fed says, all right, interest rates are high enough, we're going to start moving them down. That won't happen for a while. Then the stock market would probably get a lift. So remember, in the Weimar Republic or in Zimbabwe, the stock market was going sky high while the economy was breaking down to next to nothing. But yet, if you were in stocks, you'd say, oh my goodness, look, the stock market's higher, new high, another new high. Yeah, but still, does that new stock that you're holding on to that's going up in a number actually cover what you have to put food on the table? And the answer is no. And there would probably be certain stocks, but the point being that the stock market on aggregate, on the whole, went up, and it was much better than having money in the bank, but it wasn't as good as gold and silver, and it didn't cover. The only thing that covered in the Weimar Republic that made you whole financially were the precious metals.
And In terms of that idea of the difference between the economy and the financial markets, and you're saying that the economy is significantly suffering. And what we're seeing collapse in asset prices, and then at the same time we're seeing inflation rocketing. So that's having a major impact on people's ability to, their quality of life, their standards of living. We've got mortgage rates in the US that have shot up significantly over the last 6 to 9 months. Do you see this getting progressively worse? I mean, where does this go that people aren't necessarily currently thinking?
Yes, it will get worse. I mean, as the late Jim Dines used to say, a trend in motion continues until it actually stops. What the heck does that mean? Well, the trend is a down economy, a financial market that will show that reality at some point, and we're just getting started, unfortunately. I mean, is the stock market going to drop 50% from its high? I'd argue probably will, and we're not there yet. So I think the answer is simple to me, and that is we've got to hit bottom, and we haven't hit bottom. And what's bottom in the DJI? I don't know. What is it in the S&P? I don't know. What is it interest rate wise for the bond market? I don't know. What I do know is the trend is established, it's going to continue, and it's going to get worse. Doesn't mean the end of the world. Really, when the financial markets reflect the true economy that we've been hurting for some time, and debts are paid off by reneging on them, unable to pay. So there'll be a lot of non-payment that will destroy the monetary sphere as far as, let's say, corporate bonds, for an example, and other areas. You'll see people trying to inflate their way out. So you'll see some more Zimbabwe type of situations in probably third world countries mostly. And eventually you'll see the dollar not being trusted on the international markets. And that's what we're already seeing. Japan's had enough of the treasury bills. Russia's had enough. Even China said enough is enough. So you don't really have many nation states that are willing to take the most sacrosanct, safe investment available. And that's what the future worth of a dollar will be. If you don't trust what a dollar will be in the near term at 9.8%, why would you trust it at 30 or, at 10 years out when you can get, 2.5% for it and you know inflation's at 10? You won't. So you're down to the buyer of last resort, which of course is the Federal Reserve, and they're buying so much of this stuff that nobody wants that you've got like 2 trillion that's in the overnight repo market. So the banks don't want to loan it because no one's going to be able to pay it back. The economy is suffering drastically, so no one really wants a loan anyway. And those that do maybe are too high a risk. I mean, people that are broke want to borrow, but they're not going to get a loan from a bank because the bank knows they can't pay it back. So what happens is the bank has all these excess reserves. They loan it back to the Fed on an overnight basis and collect interest of it risk-free. So the Fed is in a box that they cannot get out of. The way that most likely will take place is they'll just inflate it away, which means that 9.8% will look tame and we could get even higher. Now, I also believe that we're going to see the peak in inflation on a number basis here fairly shortly because some of the commodities that make up the CPI or the PPI have come off in price. But that's temporary. I mean, remember the main theme I'm trying to make here, and that is, what is the economy doing? Yes, pay attention to the financial markets. And yes, certainly pay attention to what the metals are doing. And it is interconnected, but not on a very strong correlation. Again, the financial markets need to reflect the true state of the economy, which is significantly lower than it was, say, in 2019.
And you talked about the concept of the Federal Reserve pivot, doing a 180 pivot. What do you think has to happen for that to happen?
I think it's going to be political pressure. I think that the Fed will throw in the towel when there's so much pain and agony in the U.S. and other places, but they're looking primarily at the U.S. and they'll say we can't really raise interest rates any higher. We need to bring them down. Of course, once they do that, then the whole world knows what Japan knows. We don't want any more of your paper, short or long term, and Russia doesn't want any more of their U.S. paper. Neither does China, and neither does anybody else. The euro is a disaster. Europe is failing as we speak. So what happens is the Fed is the buyer of last resort and just starts printing even more. Printing meaning you turn in debt, treasury bills, treasury notes, treasury bonds, you turn them into cash. You take that cash and you spend it before the value degrades any further. And that's when you have basically a run on the dollar, what I refer to as a currency crisis. And under a currency crisis, anybody that's holding US dollars, especially overseas, which is like 60% of the base money supply, they're going to lose faith. And when they lose faith, you can't get it back. That's the real tipping point, not when they pivot, but when the psychology changes that even this dollar is doing better than, let's say, the yen, or maybe better than the euro, but they realize that even though it's doing better than those currencies, it's not doing this, one, as good as gold, and two, it's rapidly losing its purchasing power. I need to buy something with it now because whatever I buy will be less costly than what it will be in the future. If and when that psychology takes place, and I believe it will, then the run to gold will go in a significant way. And you'll see the gold price in terms of US dollars or in terms of any fiat paper currency accelerate.
So what you're talking about there is effectively is the US dollar losing its reserve currency status. And there's talk about BRIC countries potentially creating a commodity-backed currency. Is that something that you can envisage happening? Because the situation that you're describing there would seem like a perfect environment for something like that to succeed.
Yeah, so I haven't looked into it deeply. Of course, I have to study all this stuff, and I'm certainly aware of it. I think certainly it's a possibility. It would definitely gain favor with the financial markets. I mean, anyone that has any sense would go, would you rather have a currency that's backed by reality or one that's a total fiction? And the answer is I'd rather go with reality. The issue I have with it, Dave, is that it's a basket of commodities. And that's well and good, and it kind of makes sense. But how much oil do you put in, and how much wheat do you put in? And those are variables, and the price changes with supply and demand. Whereas if you just make it simple and you put it on a gold standard, it's real easy. And there's one thing. So really, to me, it's overthinking the situation. Oh, basket of commodities. No, just go back to gold. And there's been talk about the gold yuan years and years ago. It's not happened. It could. I'm not sure it will. I'm not stating that it will happen. But the same thing with the BRICS. I mean, if they were just kept it very simple and made it, equivalent to a certain weight of gold, that would be something everybody understands. And gold's got a huge mass above ground. I mean, the amount of mining that happens every year adding to the gold supply is a small percentage of what already exists. So you don't have the ability to inflate the gold supply like you do, like it could happen with the basket of commodities. Let's just say that, oil's in there. And of course, oil's going up and up and up. And all of a sudden there's a huge discovery, which is very doubtful in my mind. But the point I'm making is that if you had a huge change in that particular commodity, now your basket of commodities has really got to be adjusted by the market. Whereas gold, it wouldn't adjust that much once it got to the level that the market determined the value of gold relative to goods and services. And that would take place naturally if and only if the political class stayed away from it, the financial pundits, the financial money masters left it alone and let the market determine. If the market interest rates were determined by the market, we wouldn't be in the mess we're in now. It's only when the nice government men decided that they would have central control of the economy, what they call the economy, really the financial markets, when they decided that they knew better than we did, meaning the aggregate of people buying and selling in a free manner, free and fair manner, that they started to distort things so bad that many of the pundits that I associate with call it financial repression, which is a very accurate term. They're basically holding the value of what the cost of money is. Remember, an interest rate is the return, but it also tells you something about the value. I mean, if it costs nothing to have money, then how valuable is it? Or if you've got a negative interest rate and someone will pay you, which is the most absurd thing you could think of in finance, to hold them money, how valuable is it? It's not very valuable. You're getting a negative interest rate. In fact, if you have any common sense whatsoever at all, you'd realize this is the end game. This is the end game. We are in it now. We just don't know it yet because the grocery stores are still open. And I'm not saying they're closing, but some may. So there we go. I mean, I know I sound like Mr. Doom, Gloom, Boom, but the reality is we will have a decrease in living standard across the planet, and we're going to survive it. We're going to get through it. But we really need someone willing to tell the truth. And until we have a system that does that, we are going to be in a financial depression. And the solution that so far has come from the political and the financial elite is we need more control, not less. And you will get less and less a standard of living. You actually own nothing, and you're going to love it. And if that isn't an oxymoron, I don't know what is. Think about it. You know, if no one owns anything, then who owns it? Who are we renting it from? Oh, yeah, the money masters. Oh, the elites own it all. We don't. Oh, we're so happy.
It's been an absolute pleasure chatting to you again today. But listen, before we wrap up, how can our viewers find out more about what it is that you do?
Oh, the best place is go to themorganreport.com and sign up for our free service. If you're interested in the subscription-based part, there's a subscribe tab that you can peruse and find out. We brought back the basic service, so it's relatively cheaper than almost anyone else in my industry. And then we have the premium service where I do videos in between the monthly newsletters. And then we have an advanced service for those that are accredited investors or fund managers. So there's primarily there's a free service. I do a lot of these interviews for free, and I publish a lot for free. And yet, of course, I make a living by looking deeper, and we look at primarily the equity side. We do look at ETFs, and we look at the physical market, and we look at even futures from time to time. But that's on the premium service.
Well, we're very grateful that you do. What I'm going to do is I'm going to put a link to your website and also to your Twitter handle as well for those that want to follow you on Twitter. And I'll put those in the description below this video. But for now, David Morgan, thanks for joining us on Goldcore TV again.
Thank you, David. Enjoyed the conversation.
My thanks to David Morgan for joining us on Goldcore TV. Now, don't forget to subscribe to our channel to find out more big names chatting to us about gold, silver, and the markets. We're big fans of silver here at Goldcore and agree with Mr. Morgan when he says you cannot run a society without it. As we said at the beginning, silver is a great asset to turn to when everything's booming because very few industries can boom without silver. But conversely, it's a very good thing to have when things are more gloomy because of its role as a safe haven in your portfolio. If you're interested in getting started with silver, then please have a look at goldcore.com. We've both silver bars and silver coins to suit a range of investors, not to mention a very easy sign-up process and a friendly team who are happy to help you get started. If you'd like to learn more about silver and see more of David Morgan, then please check out the third episode of our new show, the M3 Report, where we've exclusive content with him, technical analysis from Garrett Soloway, and some excellent commentary from the Goldcore team. You can find all of that and more on Goldcore TV. Thanks for watching.